In this episode, I dive into some examples of an advanced IBC concept that I call creating strategic loan balances to take your system to the next level. I'm Nate. I make sense out of money. This is Dollars and Nonsense. If you follow the herd, you will be slaughtered. All right, everybody, welcome back to the show. It's great to be here. We're going to dive into something a bit more advanced. So I always like to put a caveat about that, hey, if this is your first introduction to infinite banking, you might want to start somewhere else, because if you start here, you pretty much have no idea what I'm talking about. You'll probably get confused and we'll never get you back. So go ahead and start somewhere else. Go take our free beginners course online to understand really what we got going on. And then we'll dive in and then come back to this episode. I've talked about this before. I've talked about this a couple of times, strategic loan balance. I did a podcast episode, like a standalone, on the idea of strategic loan balances. And it's also a part of the 4 stages of IBC commitment webinar that I've done and promoted many times on this show, because I think it's probably the best piece of content to help people understand how IBC should be implemented in their own life. What I want to do today is go in and dive into kind of 2 different examples of how it may play out in somebody's life. First, I wanted to define what a strategic loan balance is to begin with. And essentially, a strategic loan balance, Nelson Nash brought up, especially in his book, second book called Warehouse of Wealth, the idea of using policy loan balances inside of your banking system as a way to store windfall money when it comes in at some point in time. And so the way I define it is that a strategic loan balance inside of your infinite banking policy system is anytime you're going to borrow money from a policy and have a loan balance without intention to repay it in an orderly fashion. You're going to have policy loan balances that you don't intend to repay right away for a very specific reason. Most of the time, it's to increase some sort of flexibility in the long term to be able to dump in money, maybe like windfall money, or maybe you're in business and you have a random good year that just blew the other years out of the water. And what I'm saying is it's actually really nice to have what we call a strategic loan balance, having a place to dump money into your IBC system. Without the strategic loan balance concept existing in your system, if you were to have some sort of a good financial year or windfall money or something like that, you wouldn't be able to just dump money into your policies because of the MEC limits. So you'd always have to start a brand new policy every time you get a windfall or having a good year in business. And that is not the end of the world, by the way. So if you don't have the strategic loan balance, you have to open new policies when those events happen. The problem is, to open new policies, oftentimes they have to be funded over a period of time. And so if you are a business owner and you have a good year in one year, you'd like to make a big dump into your banking system, but if there's no real place to put it because you're already maxing out your policies and there's no room left due to the MEC limits, you might say, well, I'm not sure if I know if I can start a new policy with this money because I don't know if it's going to be there next year. And you have all these questions. And so here comes the idea of a strategic loan balance, that if you have already created this concept, if you built your life and having a strategic loan balance available to you, then a windfall in your business may occur, or a windfall, someone may pass away, leave you an inheritance. You may own assets that might get sold. You might get a job that pays you more money. And suddenly, instead of having to open a new policy every time something good happens financially, to be able to fit the money into the bank, quote unquote, the banking system, now you can just use it, go take a big lump sum dump into your policy loan balance to pay it off. And so the idea of the strategic loan balance is that, hey, we're going to create a place to store random dump-ins of money in our system. And we're going to create it on purpose. So the idea is this: you can't just call anything a strategic loan balance. Like, you can't just say, you can't borrow money to buy a car and call the car loan balance a strategic loan balance per se. The reason why we use the term strategic is, hey, I'm borrowing it. It's going to create value in and of itself, and it's going to sit outside waiting for a time where it may make sense to dump in some money. So I'm going to go just really through 2 examples in today's episode. I'm going to kind of draw them out. And so on the first option, the idea would be this: let's put ourselves in a role play scenario, and we're going to say that you have $100,000 in cash value, and you have a good investment opportunity come your way or something like that, and you're going to go invest that $100,000 into something that's going to pay you a 15% rate of return in cash flow. That means it's going to write you a check for $15,000 a year The idea is that most people, I think, would tend to just use this income to pay back this policy loan that we borrowed. So we had $100,000 of cash value. We borrowed out $100,000. We made the investment. And as it's producing income, we'll just dump the money in to repay the policy loan and pay down the balance till it hits zero. And that's a perfectly acceptable way to operate. But instead, we could add a strategic loan balance flair to this whole scenario and create a world in which now the policy loan balance isn't deteriorating down to zero, but we keep the policy loan balance in effect and leave it there to allow for windfall and random dump-ins of money. And so instead of paying the $15,000 a year of interest income from this investment back to the policy loan, what if we only paid the interest on the policy loan? And let's just pretend the interest is 5%. So $5,000 of interest on the policy loan. So what if we just paid back the $5,000 of interest on the policy loan? Remember, we're getting $15,000 a year from the investment, which would leave that essentially $10,000 of additional interest that we decide we're not going to put back in to repay the policy loan. But we know this has to go do something to produce value. In other words, there's no reason just to let that sit around burning a hole in your pocket in a checking account. So what if instead we use this $10,000 to pay the policy premium on a new policy each year, in order to add paid-up addition rider premiums to an existing policy or something of that sort, to where now we are not actually paying down the policy loan balance. We're leaving it there on purpose. Even though we have the cash flow to pay it down, we're going to leave it there on purpose and instead use some cash flow to open a new policy just because we want to have the $100,000 policy loan sitting there available to me to be able to dump random amounts of money in whenever I want to. If I didn't do it this way, then pretty soon the loan balance would go down to zero because I'm paying it back with this $15,000 a year, and then I'd be back where I started. And so the idea would be, okay, what if I treated this more like a strategic loan balance? I'm going to hold the loan balance. I'm not going to pay it back on purpose. In fact, I'm just going to pay interest on it, which in this little scenario, by the way, can be very helpful because the interest is actually a tax deduction if used for business or investment purpose. That kind of adds a new benefit to not paying down the loan balance. You can keep your tax deductions high, offsetting some of the positive income from the investment. I'm not going to dive into all of that right now, but the idea would be, hey, we're going to keep the strategic loan balance here and ready so that I can dump in money. If I have a good year in business and want to dump in $50,000, I'm welcome to go do that. But remember, you can't just take policy loans without really correspondingly somehow increasing premiums alongside of it. Because here's the idea. Let's say 5 years down the road, we've done this strategy right here. We've done, this strategy. 5 years down the road, we still have the $100,000 loan balance. Let's say we sell the asset that we had invested the $100,000 in, and let's just keep it simple and assume that you just get back your $100,000 with no profit or anything like that. Essentially, what you were able to do is you'd have a policy that you had put in $10,000 a year into for the last 5 years from the proceeds of that investment. And when the investment sells, you would go dump it in to pay back the policy loan balance itself. So now the policy loan balance has gone back to zero, and you have a brand new policy that has $50,000 put in over those 5 years that's rocking and rolling, highly profitable. So you have to have both at the same time. Normally, pretty much every scenario that you're creating a strategic loan balance, it has to coincide somehow with increased premium amounts so that it actually makes sense logically. If you didn't have the new policy started, then all you would have done was paid extra interest over time to the insurance company just to be sitting on cash sitting somewhere else. So you have to use a strategic loan balance in some way to expand your system so that your future growth of policies is going to be greater than if you had just paid the loan back quickly. That's the whole idea. So that was one option, one way it could play out. That, hey, instead of me taking all of the investment income I'm receiving from investments I've made with policy loans and just rolling it back in to pay down the loan balance over time, what if I just paid the interest on the policy loans and instead used the excess cash flow that I have available from those investments to open a new policy? That way I can preserve the loan balance to hold random amounts of money. I'm not going to schedule repayments to pay it down. I'm just going to pay it down whenever I want. Maybe I have a good year in business, as I said. Maybe I sell something. Maybe I have an inheritance, something like that to fit money into. Another option that kind of makes sense, maybe in a little bit of a different light, is where you are more deliberate about creating a strategic loan balance.
Are you tired of feeling like everyone has their hand in your pocket? At Living Wealth, we believe in challenging the status quo. After all, most of those conventional tools only seem to make someone else rich. Let us show you how to take back control by banking on yourself. Visit livingwealth.com/escape-the-bank. You'll receive instant access to what we call the beginner's course. This free, in-depth, easy-to-follow course teaches people how to create and profit from infinite banking. We not only discuss the philosophy and principles behind infinite banking, but also offer real-life examples to demonstrate how it works. Even folks experienced with infinite banking often tell us they learned a ton too. So, it's worthwhile regardless of your experience level. Stop letting banks and Wall Street dictate your financial future. Again, that's livingwealth.com/escape-the-bank to gain access to the free course today. Now back to Nate and Holly.
So the first option was maybe less deliberate, like you were going to do the policy loan anyway to make the investment. We're just choosing on the back end not to pay it down rapidly, but instead we're choosing to capitalize more policies and pay down the loan balance with random amounts of money sometime down the road. And the second option I'm going to describe, it's actually a bit more deliberate. Like we're deliberately going to create a strategic loan balance. And so it could look something like this. Let's say somebody is an individual who pays tax in April every year. And we're going to assume that they have a $50,000 tax bill due each year. And of course, if you're going to owe taxes, you have to set money aside somehow, some way to pay the tax man when he comes knocking on the door every April. And so what's essentially, you normally just pay that out of your own cash flow, your own cash. You save money aside, you set it aside somehow, some way to be able to end up affording to pay the tax man when he comes. And you've been doing that while also practicing infinite banking. You have policies and you just haven't really been using them at all in this. Like, here's kind of an idea. You could be the kind of person who says, yeah, I own a business, and it can have great years. It can have average years. It can have down years. It can have everywhere in between. But really, no matter what my income does, I want to be able to stuff a lot of money into policy. So even if I have a good year, I do want to have a place, what we call the strategic loan balance, just be able to dump some money into. A loan balance that is not out there being repaid by me. So in other words, like if I had borrowed $500,000 to invest in something, I could do a strategic loan balance kind of option one style. Or in reality, I could just have the investment returns pay back the loan, which is pretty common. Or maybe I borrow $500,000 to pay off some commercial real estate debt, maybe, or something like that. And I'm just taking the mortgage payment I used to make to the commercial loan people, paying it back to my policies. So I already have this debt kind of squared away. I know what's going on. A strategic loan balance always implies that instead of repaying policy loans on a strategic fashion, you're going to let them sit out there and instead use available resources to capitalize banking systems. So the idea would be if I had $50,000 tax bill owed every single year, I've been paying it out of my pocket. What I could do is say, you know what? I am the guy who wants to have a strategic loan balance. I want to have a place to put windfalls. I'm going to sell my business one day. I'm going to sell out of real estate properties at random intervals and have windfall money. My parents are going to pass away one day and leave an inheritance, or the likelihood of me experiencing windfalls in the future in random ways is pretty high. So we're going to be deliberate about, maybe we'll just create the strategic loan balance. And so what we'll do is we'll assume that we take a policy loan each year from our system to pay the tax bill. This is just an idea. So policy loan to pay for the taxes. So now, instead of you paying taxes out of your pocket, out of your checking account, that you've been setting aside money to pay taxes each year, now you're going to use your policy to pay the tax that's going to be due each year. If we didn't want to create a strategic loan balance, naturally we would think, okay, I'll just take the $50,000 of cash flow that I normally set aside to pay taxes, and I'll just pay the loan back throughout the year, and then it'll be there again to use next year. And then I'll pay the loan back throughout the year, and then it'll be there to use next year. But if we're going to create a strategic loan balance, we don't want to get rid of the loan. And so the idea would be, instead of using your tax cash flow that you've always been setting aside to pay for taxes, instead of using that to pay the loan back to the policy, Or, of course, instead of using it to pay taxes, because now we're not using that money to pay taxes, we're using a policy loan to pay taxes from some sort of existing policy. What if we use that to pay premiums? So the $50,000 a year of cash flow that used to be going to the tax man can now be used to open a new policy potentially. And so we'll just use the policy loan to pay the tax instead of your cash flow. And then we'll use your cash flow to start a brand new policy. And maybe we do that for 5 years. So you end up borrowing a total out of your system of $250,000 to create pretty deliberately a strategic loan balance inside of your policies. So now you're creating it on purpose. And so you've borrowed 50 grand a year for 5 years to pay taxes that you were going to pay anyway. And the money that you normally would have paid for the tax man, you're just going to use to fund a policy. So now you have a policy that's been funded with $250,000 of cash flow has gone into that new policy, and you have a policy loan outstanding for $250,000, a strategic loan balance, but you created it on purpose so that anytime you have a windfall, whether it's year 2, whether it's year 7, no matter when the windfall occurs, you have a place to just randomly dump money into. You don't need to start a brand new policy every time something good happens financially, which is kind of the old way of doing IBC. The idea of having a place to store windfalls and having loan balances available to store those windfalls makes a lot of sense and can be very beneficial. On top of that, by doing this, of course, you own another policy that you wouldn't have been able to open anyway, otherwise, outside of this model. So, of course, there'll be some more death benefit to the family by having, a strategic loan balance and a new policy started. There's going to be more future dividends and cash flow to profit you down the road. So anytime we can create it in a reasonable way, it oftentimes makes sense. The people who wouldn't want to do this, of course, it adds a little bit of complexity. I mean, if you want more of a simple approach to IBC, that's fine. On another note, if you really think it's pretty unlikely that you're going to have occasional windfalls of money, like maybe you have a pretty steady W-2 job, no inheritance down the road, you're not a big investor, there's pretty just steady things. There's not really much of a reason to. I mean, you certainly are welcome to, maybe not a huge one. That would be the idea. Maybe instead of talking like $250,000 strategic loan balances, which of course is big to some people, not big to others, but instead of creating a large strategic loan balance, maybe you just create a small one of $20,000-$30,000 in order to have the ability to be extremely flexible. So the idea would look like this. After 5 years in this example, let's say we do this for 5 years, we fund this policy for 5 years. And at that point, you receive a $250,000 windfall. And so a $250,000 windfall comes into your pocket, and you immediately just pay back this loan balance instead of having to start a brand new policy at that point. What have we really done in the grand scheme of things? We have a policy that's already 5 years old, that's already extremely profitable, that's already growing by more than you're putting in, that you don't have to go through underwriting again. You don't have to worry about whether you're healthy or anything like that, like starting a new policy. It's like dumping in $250,000 and backdating a policy for 5 years is kind of what it looks like. I mean, essentially, you haven't put any quote unquote of your own net money into it. In other words, you've put in $50,000 and you've taken out $50,000 from the policy system that you've created each year. So you're kind of not really putting in any change to your life. You haven't really put in any money. But 5 years down the road, you can write one check and it looks exactly as if you had been putting in $50,000 checks the whole time, because that's really what you've been doing. So the idea, I like that the way Nelson Nash put it. It's kind of like being able to backdate a policy for 5 years ago and starting today with real money going in. But it looks like it's already 5 years been maturing. It's a pretty cool idea. Nelson Nash, even in his Warehouse of Wealth book, described kind of how that works for him, being able to get a windfall and paying back policy loans on policies he had started 10, 12, 13 years ago. And you just dump one check in, pay back, the loan, and you got this policy fully funded that you haven't really put much real money into out of your, as a net. And suddenly it looks like it's a 13-year-old awesome policy. It's like you backdated a policy for 13 years without having to go through underwriting. So we think it's a pretty cool concept. It's not for everybody per se, but anytime you're an individual, an entrepreneur especially, or an investor, or someone who's expecting an inheritance or anything in between, there can be a real benefit to having a strategic loan balance build just to be able to dump random money in. This type of thinking can also be done if you, let's say you have a down year in business And so I guess this could almost be option number 3, by the way. I'm gonna go ahead and write it down as option number 3, even though I wasn't planning on it. But this could be like an option number 3 idea. Essentially, let's say you have an individual who's got one policy, and let's say you put in $100,000 a year of premium into your one policy. I know that's a big number, but it's a nice even round number. So let's say you put in $100,000 a year to your policy, and you max it out every year, which means if you guys have ever been paying attention to my videos in the past, every policy essentially has a window to pay premiums. At the very top of the window is that thing called the MEC limit. So every policy is going to have a cap to it. You can't fund more than that to this policy. At the beginning of every policy, you get to decide what the cap's going to be, essentially. Like, you can start a policy with any MEC limit you want, but once it's started, that's what the cap is at the top. At the bottom is called the base premium, and you fill it up with the paid up additions rider, the PUA rider. And so in a $100,000 policy, maybe it's like a $100,000 MEC limit with maybe like a $30,000 base premium approximately, and like a $70,000 paid up addition rider contribution each year. And the PUA rider is always a flexible number. And the reason why I'm bringing this up for option 3 of how to create a strategic loan balance is because the way we've always taught it is that, hey, you want to build policies. Like, if you're going to put in $100,000 a year, you want to build the policy around what you think you're going to want to contribute every year and have the capacity to contribute. You want to build it that way. But just because you want to contribute it and think you'll be able to doesn't mean you always will be able to. So, I mean, bad things happen financially occasionally. So you might have a guy who's been putting in $100,000 a year to the policy, but has a bad year in business and suddenly can't make the $100,000 contribution that he normally would have made, but it's going to make some sort of lower amount. Let's pretend it's just the base premium. And so instead of contributing $100,000 under normal circumstances, he would say, I'm just going to fund the base premium of $30,000 this year. I'm not going to fund any paid up additions. I mean, that's perfectly fine. We do all the time. In fact, most companies have like a makeup thing for the next year. In other words, if you miss the paid up addition for 1 year, you can make it up the following year and kind of double up on the paid up addition rider premium. But what I'm trying to bring up is there is a different solution that is available that's more of a strategic loan balance concept. And that would be that, hey, well, if he has cash value in the policy, I mean, if he wants to, he could just borrow $70,000 from the policy itself, take the $30,000 that he wants to put in his down year, take the $70,000 in a policy loan and write a check for $100,000 and max out the policy that year. And now he's got a $70,000 loan balance that he can really treat like a strategic loan balance. He's not planning on repaying it, but he's expecting business to pick back up in the future years. And so he will just simply use that strategic loan balance as a way to dump random amounts of money. So maybe in a couple of years, he's able to get back to maxing out the policy and has money to pay back the strategic loan balance with profit. Well, he could just dump some money in to pay back the loan balance, and his policy looks exactly as if he had funded it at the full amount the whole time, which he did. But there was that 1 year, a couple of years before, right, that he didn't actually fund it out with cash flow. He just funded it with a policy loan. And so the reason why I wanted to bring this one up is because the idea of having strategic loan balances and being comfortable with them really frees me up to where I don't have to, I've said it many times, I'm never really worried about where money's going to come from to pay premiums. It's either I'm going to earn it by working and having a good year in business, and I'm going to be able to fund all the policies from cash flow that I've earned, or I'm going to reduce paid up addition rider premiums and just not fund all the PUAs available to me, or I'm going to borrow some money from cash value to be able to max out all the policies because I may want to have a strategic loan balance in operation for me because I'm expecting windfalls in the future. So really the main benefit of strategic loan balances is to create a world where there's far more flexibility funding wise than what you can normally get just practicing IBC, paying premiums out of cash flow. On top of that, it allows you to typically, in almost every instance, having a strategic loan balance has to also coincide with additional premium. Anytime you can do both at the same time, you've created more cash value, more death benefit, more capital's been contributed to your IBC system, which allows for higher future, profits to be earned inside the banking system. So I hope this has been helpful. We've probably beat the horse to death at this point, but it's been fun once again. I love diving into some advanced content as often as we can. That is the goal of the Dollars and Nonsense show, is not to just do superficial top of the funnel content, but to truly dive into some of the weeds and some of the philosophies and strategies that would be more advanced IBC related. And this is certainly one of them, probably the most advanced that most people are going to get involved with. If you want to have an actual illustration of a strategic loan balances at work, I would recommend you go watch the 4 stages of IBC commitment webinar. You can get that on our YouTube channel. It's just simply because we actually, in that example, I show you another idea of when it would make sense to do it with real numbers playing out of how it's going to work. So if you want to watch how they work out with real numbers, go watch the 4 stages of IBC commitment webinar. It's about an hour long. Honestly, you should just watch the whole thing. I think you'll love it. The entire hour long, not just the strategic loan balance section. But thank you guys so much for being here again. This has been Dollars and Nonsense. If you follow the herd, you will be slaughtered. For free transcripts and resources, please visit livingwealth.com/E216.
Listener, one last thing before you go. Start your journey towards financial security and wealth today. Visit livingwealth.com/escape the bank. Upon completing this course, you'll have all the information that you'll need to see if infinite banking is right for you. Again, go to livingwealth.com/escape the bank.